Okay, so this is our tutorial today. Group B, yeah, this is your video, and we are doing cost of capital for this week's tutorial. So we want to understand what cost of capital is all about, and and solve some questions here. So cost of capital, when you hear such words, it's just the amount of return that obviously investors will expect from the amount of investments that they've invested in. And what is capital made up of? Capital is comprised of or equity, okay, things like common stocks, preferred, and and also your debt part as well, loans or bonds. All those things make up what they call your capital, and you get to calculate your cost of capital in a company and determine what rate you'll use as a return to your investors. So let's look at some questions. Otherwise, in general, this topic is very much fair. You can actually score full marks here. Sometimes a full question would come on cost of capital like 25 marks. Yeah, some sessionals do have that, even some test tools as well. So just make sure you polish up this topic. It's just about understanding some terminologies they use, the formulas. It's equally good formulas, this topic. Just get to grasp that as well. Then you're home and dry this topic. So what you just need to know as we'll be solving questions is that when you're asked for WACC, which they would call the weighted average cost of a capital rate, it comprises of weight of what? One particular structure, which is debt, multiplied by the cost of debt plus weight of the other structure, maybe equity, and cost of equity plus weight of another capital structure, which is preferred stock, multiplied by cost of preferred stock. Okay, you would have your debt, equity, preferred stock. I'm sure you've even heard of retained earnings, right? Yeah, so retained earnings, if you really get back to your notes, retained earnings is the same as equity, okay? Yeah, these two, cost of equity, cost of retained earnings, they are categorized in the same bracket. And one thing you need to notice about this particular topic in general, they would say equity is okay, if you go and do research, equity is actually like common stock and preferred stock. But please take note of this for this topic. Have you noticed that they do not mix preferred and that weight equity in one thing, right? Please take note of that. They categorize them separately. Yeah, I think it should be the reason behind that. The reason behind why they do this, personally, what I've analyzed is that you're trying to gauge the cost of maybe different forms of financing, and that is why they avoid mixing preferred when they say equity. Okay, equity here, they'll just look at common, and the one which they're equating, retained earnings. Please take note of that. So let's look at the question with this understanding, and as we go to these particular questions, please want to apply. So in general, a company wants to find the optimal capital structure that what minimizes cost of capital. That's the reason why we create a weighted average cost of capital, to minimize that cost of capital. So let's get to questions now. So you have that question. This is from your exercise document, by the way, from your sir. Question 1 says Trends Limited has 200 million total net assets. It plans to increase its production and machinery in 2012 by 50 million. Bond financing at an interest rate of 12% will sell at par. Preferred stock will have a 14% dividend payment and it will be sold at par for 100 kwacha. Common stock currently sells for 50 kwacha per share and can be sold to net 45. There is 10 million of internal funding available from retained earnings. Over the past few years, dividend yield has been 6% and the firm's growth rate is 8%. The tax rate is 35%. The present capital structure shown below is considered optimal. So this is what they have as a capital structure, which they view will be optimal and will help minimize that cost of capital. So you have those structures and the amounts of each structure. Then they ask you how much of the 50 million must be financed by equity if the current capital structure must be maintained. They are looking for equity. Remember our intro to this video when we said which things do they pick as equity under this topic of cost of capital. If you rewind the video, we said that in this cost of capital, they get to categorize equity as common stock and retained earnings, according to how even your notes have been outlined. So you would pick the 40,000 there and the 60,000, so that you can just know what portion of the business is being financed by equity. And let me show you the next screen so that you can know. And take note of the total claims. That's 200 million, right? We'll need this figure so that you can just know the portion that equity has in the total claims. So if you add 40 and 60 million, what do you get? 100 million, right? You have 100 million. You have to divide by the total claims so that you can know what portion this particular equity has in the whole total claims. This gives you 50%. Now just take a decimal. I like decimals myself. There's a reason why I haven't taken a decimal in this case, because they want to know what portion of this particular, what portion, or let me just say 50% for those that want that. So we want to know what portion of that 50 million will be raised by equity. So first, equity takes up 50% of the total claims, meaning if they want to raise 50 million, right? Like in our case, 50 million, meaning you just multiply by the portion, giving you 25 million. And that's your figure. That's what will be raised by by equity, which is just common stock and retained earnings. Part 1 answered. Let's go to the next part. How much of equity funding must come from sale of new common stock? How much of equity funding? Look at the particular question. There's something. Okay, you want to raise total. It's 25 that equity should supply these new funds from what we've determined. That now they're saying how much of equity funding must come from the sale of those same new common stock, because you need 25, but how much should come from the sale of new? Does the company have maybe any former equity there that they've mentioned up there? They've said that there is a 10 million internal funding available for retained earnings. Please, this detail is very important. Retained earnings, we said we're also categorizing these as equity because of that, the way they've denoted this to cost of equity is equal to the same cost of retained earnings. So they have 10 million of retained earnings. Now they want to ask how much, of those needed portion, that's 25 in total, but how much, must come from new. So you already have 10. Your end game is to reach 25 because that's how much you're supplying. So I don't know, what's the difference here? 15 million. That's what you write. 15, so 25 minus 10, so you can know which portion will come from the new stock, and then you get 15. This one is just 15 million, the answer. Part C, what is trend's cost of new equity? New equity, you heard that word, new equity. When you hear new equity, then you'll get to calculate common stock, cost of equity, you get to calculate cost of equity for new versus new stock. And which figure do you use? Because we have that selling price. You look at common stock sales at 50 kwacha per share and can be sold for net 45. When you just hear that other way, that net, then you're now looking at the cost of new common stock or cost of new equity in that case. So when you just hear net, that's the price that you'll be using in the calculation of the new equity for to get on that part. So when you hear new, we just look out for that word, the net price. That's the one we get to use. And which formula do you go for when calculating cost of equity? Because mind you, there are about two formulas. One from risk and return, which follows the CAPM model, if you remember. Then there's one which follows they say the Gordon model, but I'll just tell you it's that formula we used to use when calculating the required rate of return on a stock. D1 over P0 plus G. So what will be our D1? Because from this detail we know we're going to use that Gordon's model from stock valuation. So what is D1? Has it been stated? Well, they have just mentioned something that there's that 45 price, if we're together, and then now we want to look out for the dividend that they pay as a company. So they've stated something. Let me just quickly share the screen. So that dividend yield will be very key to help us. Let me even demonstrate the dividend yield. They've said it's 6%. We need this figure to know what D1 they were paying, because dividend yield, I about share what it means. So dividend yield is what? D1 over P0. Please just remember, this is stock valuation. It's just retained to us, because you recall I told you some formulas will still visit us back, and it's in cost of capital where they do retain these formulas. So 0.06, what they told us, dividend yield is 0.06. Okay, so we want to know what price do you substitute here? Well, we are looking at the initial price first of all, so that we know the D1 that worked, okay, before we come and use this net price, which was 45 kwacha, to get the cost of new equity. So it will be a matter of changing the subject, in this scenario, where you have your D1 over, let's say 50. We said we're using 50, so that we can know the initial D1 they used to use before they got to this net price after they sold some new common stock. So you do that. What is 0.06 times 50? What answer do you get? I think this should be 3 kwacha as your D1. We've gotten our D1 because we needed the D1, of course, as we solve, because even the price of new common stock, it's the same formula. The only difference is that you do not use the initial price, you get to use the net price. Take note of that. So it's D1 which is 3, price now is 45, plus what's the growth rate? They said 8%. Add everything, you tell me that you'll land at 0.1466 as your cost of new equity, which you'll need when you solve your weighted average cost of capital. What is trends WACC? Have you heard the question? What is trends WACC? WACC is the weighted average cost of capital. Okay, so how do we do that? You remember the intro. You find the weight of a particular structure, multiply it by the cost of that particular structure. Okay, now we did not even solve the cost of debt. You've noticed in our video. Let's quickly find it before we get to work, because it's a component, cost of debt. How do we get the cost of debt? Look at the part that they've mentioned. Bond financing at an interest rate of 12%. Yeah, that rate that they put on a bond, that is basically its costs, okay, on the same date, because that's like the charge you'll be getting. But this charge has not been mentioned, okay, that it came after tax. And if they are silent, please take note of that. If they are silent that it's after tax, then you would have to find the cost of debt after tax, because that's what you're interested in. So what would be the cost of debt after tax, given that the before is 12%? Look for the tax rate. I've seen it as 35 in my case. So let's just quickly find that figure and see our cost of debt that we'll use, and of course solve our question. So we're looking at debt rates. So that's KD, that's what they say, which is the cost after tax. KI, cost before tax, 1 minus tax. KI, we said is 0.12 before, and tax rate is at 0.35. What would be your cost? So I'm getting 0.078 as my cost of debt. Then you'll get to solve weighted average cost of capital from here. So just one more detail before we move to the weighted average cost of capital itself. We've left out one of the forms of financing, preferred stock. This one as well has to be calculated separately. It's got a formula for cost of preferred stock. That's why I've been saying that that's the reason why they've been exempted from that equity section under this cost of capital topic. So cost of preferred stock is, how do you get it? The dividend over the price of preferred stock. So what's the dividend? They just told us that the dividend is at 14%, that's all, and can be sold at par, which is 100 kwacha. How do you calculate dividend value? Isn't it supposed to be multiplication of the dividend rate times the at the par value, so that you can know the rate that they are paying? That's how we used to even do it, if you remember, in stock valuation. The rate on the par value, then you get the dividend payout. Then you cannot divide by the price of preferred stock, which they've just said it's selling at par, so the price is equally 100 as well. So it's 14 over 100, which arrives you to 0.14. Let me just write that formula quickly. So we're saying they say KP, right? Cost of preferred stock is equal to dividend over price. Dividend, we found it as 0.4% of par. It gave me 14. And then what was price? It's selling at par, which is 100. Therefore, cost of preferred stock is 0.14. And you just get to calculate your whole weighted average cost. Let me even share the screen of how you do that. So that's your overall weighted average cost of capital. You just obviously say, okay, WACC is equal to that particular formula. Always state the formula, please. It's very important in this course. State your formula first, then you can substitute. How did we get by those weights? If you still recall how we used to find weights in risk and return, it's the same principle happening here. What we just do is that we would go to the form of financing, and I'll share the screen of how you can get weights again. But basically, this is how you get your weighted cost of capital by, of course, substituting the weights, the cost, so that you are getting on those particular structures. KD is just cost of debt, KE, cost of equity, KP, cost of preferred, like the way we just found these things. But let me just demonstrate weights as a refresher, but it's still the same knowledge we used to use previously. For example, they've said that debt has 80,000 million, right? That's the amount of investment in debt, 80 million. What is the overall total of every investment, right? Like they always to do it, 200 million. Then you get to find how much this is in the total investment, which is 0.4, which will be your weight of debt. Okay. Then even preferred, preferred was 20 million. 20 million over 200, another scenario, okay? Like 20 over the whole 200 million, mind you, it's million. Answer 0.1. So what you'll be doing is like, what you can just do is that you can put weights, right? So you start labeling them. Debt, you put, okay, debt is 0.4. Preferred, okay, 0.1. Equity, which we categorize as retained earnings and common stock, 0.5. Weights always add up to what? To 1. The same theory we used to use. Equity, we found we on the video, it was like 100 million over 200. That's the portion that weight has, that's equity has. And that's all. Question 2. The treasurer of new venture is trying to determine how to raise 6 million of long-term capital. Her investment advisor has devised the following capital structure. So all in all, you're trying to look out for the optimal structures. Why? That's what weighted average cost of capital is all about. The optimal structure will minimize your cost of payouts or capital. If alternative A is chosen, the company would sell 200 shares of common stock to net 20 kwacha per share. Shareholders would expect an initial dividend of 1 kwacha per share and a dividend growth rate of 7%. If alternative B is chosen, 100,000 shares of common stock would be sold at net 20 kwacha per share. The expected initial dividend would be 0.90 per share and the expected dividend growth rate would be 12%. Assume that the company earns a profit under either capital structure and that the effective tax rate is 50%. What is the cost of capital to the company under each alternative? What alternative should the treasurer adopt and why? So we'll have to come and choose amongst the alternatives available. So start calculating the cost of capital for each alternative. That's the first thing they've told us. Then we'll come and choose. So look at alternative A, for example. It has got that portion of debt and that portion of equity in terms of the investments they've put in there. Now, how do you get the weighted average costs here? Which forms of financing are they using? They are using debt and equity. That's all. You don't get to start adding preferred stock if you haven't talked about it. This is how you analyze such questions. You just focus on what has been given in the question. That's all. We have equity, we have debt. We know our work formula will just end on weight of debt, cost of debt plus weight of equity, cost of equity. That's all. Look out for now the cost. How do you get them? Cost of debt, for example. They've given you that there's a 9% there, right, on the debt. As I said, if it's not stated explicitly that this is a cost after tax, then always picture this as a cost before tax. Okay, so you have that figure there, 9%. Try and convert it to after tax. I'll share a screen very soon. Tax rate is 50. Equity, how do we get equity? Well, the paragraph has given some detail there for alternative A. The initial dividend is 1 kwacha. That word initial, remember your stock valuation. What does initial mean? That's D0. Okay, we are looking for D1 because if you're given details from stock valuation, you're going to use the stock valuation model to find that cost of equity, right? Yeah, now look at the information. We need D1 and it's D0 there. Initial 1 kwacha. So convert it via a growth rate the way we used to do. That's why never forget your knowledge from that stock valuation, especially it's applying more than even risk and return, which just applies the CAPM model only. Yeah. Then okay, you get to change that, and I'm about to share the screen of how you will be changing everything. I just want you to like identify all the components in advance before I share the screen. Look at alternative B. What would be the cost of debt in alternative B? We have a 12%, which we said they have not stated, then it's viewed as a before tax cost of debt, 12%. Convert it with a tax rate of 50%, and I'll show you. Equity, they've said alternative B has, of course, 20 watcher price. We need that price as well. Then expected initial dividend of 0.90. Have you heard the word initial? So in alternative B, they've given you D0, which has to be converted with a growth rate of 12%. Thereafter, we'll solve the weighted average cost of capital. Let me share the screen. So this is what I was trying to explain. You know, okay, WACC in this case, we are only talking about debt and equity, and that's what your WACC will comprise of. That's why I've written the formula like that. Then now start looking out for the components in the formula. Cost of debt is what? 0.09, the one which was before. Okay? And how do you convert it? It's always that cost before open brackets 1 minus tax. And the tax is 50%. I've just changed it to a decimal. Okay? It gives me a 0.045 as my cost of debt according to alternative A. On A, please, and I've even labeled it on the screen. Cost of equity, we said we've been given details from stock valuation, therefore we're using stock valuation to find our cost of equity. D1 over P0 plus G is the formula we work with. We've denoted that those dividends given were D0, and that's why you're seeing my side calculation there. D1 is equal to what? The D0 open brackets 1 plus G. They always to do it. What's G? According to alternative A, if you wind the video, it's 7%. You convert. I got 1.07 myself, and there I got my figure. Okay, and I went and calculated my weighted average costs, as you can see below. So it's okay. I didn't just put the final answer for equity, right? But it gave me 0.1235, by the way. Yeah, cost of equity 0.1235. Then I got into my formula. Weights, the same way we solve weights is the same approach. So it's like this would be your work, right? But okay, for the sake, this is the tutorial. For the sake of understanding, this is the tutorial. Let me just show you how I arrived at those weights. Okay. And to, as they say, the Chakamonike winner, if someone fails to calculate my weights, imagine 9, and you went through Mr. Kunda. Yeah, so let me just show you. So I recall under alternative A, they said that that one will have a portion of 2. It's 2 million. Okay. What were the total claims? They had 2, they also had 4. I remember these 4 was on equity. So you get to find the total claim, which is 6 million in short. That's like the total funds they want to raise. And then start finding weight. Weight is just this over that, right? It gave me a recurring figure, 0.33 as my weight for debt. Because this one was even for debt, in fact. And then equity, 4 million into that 6 gives you 0.67. And then your weights will add up to 1. Yeah, that's how I got those weights. Equity, assign it with 0.67. Debt, assign it with 0.33. Let me share the screen again. So that's how I assigned them. The cost of debt is 0.045, as you can see, plus 0.67, which is equity's weight, and the cost in the brackets. And I found 0.0976. So on the answers, I'm sure you've noticed how many decimals. Okay. Usually, okay, we would end on 4 as the maximum. Don't go over that. Yeah, just 4 as a maximum. And then you can even convert to a percentage if you feel like. Yeah, and that's all. You're done. Look at alternative B as well. So we're on alternative B. Start finding the same way we did cost of debt, cost of equity under alternative B. As we analyzed earlier on, if you rewind, we said that there's a 12% rate on that debt figure. That's your cost before, and change it to cost after tax by multiplying by 0.5, which was that was 1 minus tax, which still gave me 0.5, and I multiplied and got my cost of debt there, 0.06. Then I went to cost of equity, same model. They're talking about stocks, so we use that model to find our cost of equity. D1 wasn't given, it was just D0, which was 0.90. Convert it with a growth rate of 12%. That's 1.12, right? Yeah, this one equally was landing me to, is it 0.17 something? I remember this figure. I'll show you in the weighted average cost formula. Okay, Yeah, then I got my D1. In fact, I got my D1 first, sorry, as 1.008. Sorry for that. Then I substituted it in my formula for cost of equity. And price, we're using 20, by the way. Those that might be lost with price, they give you the price per share. That's the one you use here. Yeah, 20 in that case for alternative B, even yeah, the similar one. The growth rate is 12%. You multiply, so you add, and you get that figure as your cost of equity. Gets to WACC, the final formula itself, weighted average cost of capital. We only have equity and debt in our question as also of alternative B. Substitute the weights. The same way we got the weights is the same way we'll do it even here. This time around, the debt has 4 million. This time around, equity has 2 million in alternative B. So meaning you give the 0.67 to debt because you divide that weight, it's giving you 0.67 under alternative B debt. Weight for equity, it's 2 million. Divide that into the total claims, 6 million. You get 0.33, and that's how I've assigned it there. You put their costs there respectively. Cost of debt 0.06, cost of equity 0.1704. Answer 0.0964 as my cost of capital. Which alternative do you choose? Alternative B gave me 9.64%. Alternative A 9.76. What guides you when you're choosing the WACC to go for? We said initially that companies want to find an optimal capital structure that will minimize their cost of capital. So that's why I personally went for alternative B. But you can equally do your own research on this one. But that's usually the theory behind costs of capital. And that's how you answer question 2.